In this video, I'm going to give my thoughts on the latest Greg's trading update. And if you like this video, please drop one of these to help beat that YouTube algorithm, as it is much appreciated. So if you've been living under a rock, you don't know what Greg's is. Well, they're a British bakery chain, most famous for their sausage rolls. When we look actually at the share price in the last few periods, it hasn't actually been that strong of a performer. Over the last 5 years, it's had a very strong performance relative to its now size of £2.2 billion. However, when you go back to a shorter time span, it looks worse. Over a year, it's only down 12%. That's quite respectable considering the amount of retracement a lot of stocks have had during this time period, like those of the higher growth stocks or a lot of the AIM listed equities. However, when we look at like a 6-month period, it's down 29%, or a year-to-date period, which really grabs them on the peak there, it's down about 35%. So their performance has certainly replicated the market's downturn as of late, and it's one to be keeping an eye on. So in their trading update, they mentioned that they'd seen an increase, or a 24.7% like-for-like sales growth for the first 19 weeks. However, a 27.4% growth in like-for-like sounds promising. Like-for-like growth being the total sales of the currently open stores this year versus that of those same stores last year, excluding any closures or new openings, to find a fair balance. However, interestingly, they do mention this as well, that they're comparing company managed shops, which I understand because that is more or less directly under their control. But what they're also comparing it to is 2021, in which it was heavily influenced by the pandemic. I feel, in my opinion, it'd be a lot fairer to be comparing a larger time scale, suggesting something like 2 or 3 years, where before the pandemic we could have a good contrast to pre-pandemic sales. So it looks like and they've highlighted it as well, it looks like it is doing a lot better than it is, and I don't really like the way that has been laid out. They have mentioned obviously a lot of new shops being opened in the first 19 weeks, and they've seen 6 closures. However, they mention here they've got cost pressures increasing, and this is actually confirmed by, well, the CEO as of right now of Greggs, which is Roger Whiteside, who is actually stepping down on Tuesday. He mentioned that the price increase is going to have to be inescapable, and that they're going to have to move prices very soon. Furthermore, the price increases are likely to be about 5 to 10p, as happened at the start of the year, and then it'll be on selected items across the board, suggesting that obviously they have been actually quite hard hit overall, and the cost of living crisis has certainly impacted Greggs, even though they may be seen as more of a resilient maker. However, when you look at Greggs, their business model, and really what they offer, when you're looking at a 5 to 10p increase, it is quite a large percentage change, but realistically these goods are likely not going to see that much in a reduction of demand. In my opinion, Greggs hot food, and obviously their bakery and their drinks, for instance, I personally feel that these goods are relatively inelastic, meaning that they could probably raise prices and not see that much of a fall off in demand compared to, let's say, a fast fashion retailer like Boohoo. If they raise their prices quite dramatically, they're going to see a quite dramatic drop off in demand as the competition scoops it up. However, in Greggs' situation, obviously, I feel that they will be fine. These price increases can be reflected, and they still remain very good value. And in fact, analysts are quite bullish on this as well. We've got 3 analysts that currently follow Greggs on tip ranks, and actually the average analyst view or price target for the next 12 months is about £32.50. The high is £36 and the low is £29, all suggesting quite an upside from the current price. Even of the lower price, well, supposedly, based on this, there is a 50.46 change compared to the price close as of today, which was nearly £22, of a 50% upside, which may be quite promising if one were to be investing in Greggs. But again, we are seeing these cost pressures increase, hence why they're doing this. And in fact, they did mention there were a few reasons for this. The Greggs boss himself mentions obviously that the conflict in Eastern Europe, as Greggs have sourced a lot of sunflower oil from there, it's forced them to source alternatives, which is likely eating into their margins, as they likely negotiated good deals and it was geographically advantaged. Whereas now, obviously, they're going to see that cost pressure, which they do need to pass on, alongside the increase in VAT as well that happened in April. There's certainly a lot more pressure onto them. And they also mention here that actually their real estate, so we're talking about the whole idea here where a lot of their locations are in bigger cities, we've seen a change in the term of a lot of people now are working from home, as you know. But when you're at home, you're less likely to go, oh, I'm going to nip 10 minutes into town and grab myself a sausage roll. You're just going to think, well, there's a bacon sandwich in the fridge that I made earlier, I'm just going to eat that. Or I've got leftovers from last night, I'll just eat that. Or there's a bowl of cereal, I'll have that. You're less likely to be inclined to get it. And I suppose in a way, Greggs have combated this somewhat. And they've tried to alleviate this problem by becoming available for takeaway. However, I feel that Greggs isn't well positioned for takeaway. Yes, they have plenty of outlets across the country. They've got the numbers, they've likely got the infrastructure because they'll be using likes of Just Eat, or was it Deliveroo? I can't remember off the top of my head. However, when you're ordering a takeaway, at least in my opinion as a consumer, I look for something a little bit more substantial. I don't go, oh, you know what, I could really fancy a takeaway right now. I think I'd be wanting to get a big meal, maybe a large pizza, a curry, something like that. I'm not going to go, oh, I could really fancy a steak bake or a sausage roll that I could have probably went down Tesco's and bought and put in the microwave. It's realistically, the quality change here isn't going to be that large. Obviously, it's going to be freshly baked goods versus that of frozen or cold goods. But again, I think I would just buy something a bit more harder to make at home, sort of. But hence why it's kind of the beauty of a takeaway, where you can order perhaps a fresh pizza or the likes of obviously a curry that would be a lot more difficult to prepare at home if you didn't have the right equipment. Furthermore, because of this, they have actually seen quite a struggle because of this work from home movement. But furthermore, in this way, they've also got transport locations which are holding up quite well. However, I feel that these transport locations are a bit of a double whammy here. Because yes, transport typically, other than the unforeseen beer bug Black Swan event, which had meant they weren't ready for it, obviously, I feel that transport remains quite resilient. It's a sector that does see seasonal variation across the year, but ultimately is quite consistent and quite predictable as a lot of people are looking to travel. However, there is two sections to this, I suppose. We can talk about domestic travel and let's just say non-domestic travel for this example. When we're talking about domestic travel, a lot of that is likely going to be commuting into these larger cities, going into the offices, doing business meetings, which nowadays we're seeing a lot more Zoom, we're seeing a lot less commuters, and so therefore I think they are in a position that they're going to be struggling a little bit more. But yes, they are obviously in other locations where there is travel across the world and they're in those hotspots. And I think with that element of tourism as well, they are well positioned in that spot. But again, I think there is a little bit of struggle there as well. And they've mentioned actually that they've got a strong outlook for the future. They said their sales are in line with their plan. They've got a strong pipeline of new shop acquisitions ahead. My concern though with Greggs is actually more or less to do with their valuation. When we look at their valuation, we can see that they have about a 19 times price to earnings ratio, which is more expensive than the market of about 15.3 times. But the price to book ratio is also quite high as well. And don't forget, this is after quite that substantial drop that we'd seen of about 35% the last 6 months or year to date, and about 29%. Yes, it's not a huge drop compared to a lot of the other stocks, but still, this company is valued at £2.2 billion. And even after this pullback, they're seen as quite pricey. Well, you might go, well, Greggs has seen reduced earnings, so therefore their price to earnings ratio is artificially higher. Well, when we actually look at their past performance and really do the maths here, they're earning more earnings than ever. I'm not sure where this figure of 1.4% was pulled from, because to be fair, they have grown their earnings at a very good pace since July 2015. Their earnings has increased from £51.4 million to now £117.5 million. And the profit margins have effectively increased by a third, from 6.2% to 9.6%. In fact, in the trading update here, we can see that the total sales in the 19 weeks to the 14th of May were 495 million. So if we run the numbers here and we do obviously 52 divided by 19, which gives us 2.74. We times 495, being 495 million pounds, by 2.74, and that gives us roughly a revenue to be expected, not accounting for any seasonal valuations or any one-off items, expecting the same demand over the next periods. We'll be looking at a revenue of about 1.36 billion pounds, which interests me because yes, it's higher than what they've had before, but is it going to be sustainably higher? Is it now seen the peak? Is it going to plateau now, as we've seen a lot of difficulties with the working from home trend? Or is Greggs going to struggle? And currently at their valuation, even with the balance sheet that they have, which in my opinion is flawless, in which they have absolutely zero debt, well positioned in the term where we are looking to come into quantitative tightening obviously, and the raising of interest rates, This means if they've got any debt, they've got no worries because they haven't, and therefore they're not paying that much of an interest on it. But this does also impact consumers, as they're therefore going to be pressed for cash, which may lead them into going into a Greggs because they are good value. But it may go, as interest rates rise, well, actually, we might want to put this money into our savings. We can get a sausage roll from Aldi, for instance. So again, that comes into the picture as well. And even with a fantastic cash position of about £199 million, it's still, compared to the overall market cap, not that much relative. And I suppose you might be asking, okay, but what could Greggs do with that cash? And that's a good question. Open more stores, give out more in dividends. And when we look actually at their dividend, it's a pretty high yield already. Well, it's 2.63%, but if we include special dividends, you're looking at about 4.5%. Although historically, without special dividends, it'd been floating around 3%. So it could suggest that actually, despite them growing their dividend quite rapidly over the last few years, well, at least other than the unforeseen black swan pandemic, it could suggest that there may be more downside to come as they reach a fairer valuation. But again, they are a growing company and therefore they are seen at more of a premium. And their dividend history is phenomenal, in my opinion. Again, other than 2020, which they had initially cut and then suspended their dividend due to the unforeseen circumstances and the inability to even open their stores during lockdowns. Of course they were going to struggle, but now they're paying a dividend higher than ever. And in fact, if you look over a 5, 10 or a 15-year period, their compound annual growth rate of their dividend is extremely consistent and extremely reliable. The only point I would perhaps flag up is that during about 2011 to 2013, obviously they had grown it at a very, very low level and again stopped growing it whatsoever as well, which was obviously as to be expected coming out of the global financial crisis of the property crash, well, not the property crash, but the global financial crisis due to subprime mortgages and basically over leverage really by the banks there. I'm not surprised that perhaps they tapered off because that was quite a significant recession in our lifetimes, and therefore obviously it's understandable that they paused it, but they continued to pay the dividend during that time, which makes them quite a reliable business. In my opinion, Greggs truly is a fantastic business, but is it worth the valuation that they're currently at? It's great to buy, obviously, a fantastic company at a fair price, but it's really evaluating, is that a fair price for Greggs? Do they have much more growth ahead of them? Or now are things going to level off a bit as, obviously, we've really seen the most of it? Or perhaps in the future, we're going to go, you know what, people are going to go to the office a lot more. People are working out, actually, people working from home, less productive. Let's bring them into the office 3 or 4 times a week. Let's get those people commuted in. We'll pay for their travel or something like that. And that's going to lead to a general increase in, I think, the total sales. So it could be a good play if you believe work from home will be a trend that will slowly die off. Thank you for watching. Have a fantastic day.